Hey everybody, today is December the 17th, 2017. Wanted to provide you with a market brief. So, very busy looking chart here, but I'll show you sort of what we're looking at. So in regards to various markets, you can take a look and see here is the equity market that most people say the market is. This is the S&P 500 index, so about 505 stocks. I'm going to move this. It'll probably bounce around a bit, sorry. And what we're seeing is a 5-year look back on this index. So a very nice run from around November the 9th of 2016. So we had this beautiful thing happen until January of 2018, which you can see right here is this little red peak right here. And from that point, January of 2018 until today, we're up 11 or 12%. Very nice, but certainly not a barn burner, if you will. So you've been hearing a lot of chatter from the media. We're making all-time highs. The market's doing X percentage up. I can't remember what it is. They are measuring from where I have my cursor right here. This is the second day of January of this year. What do you see on this chart that's different? You see volatility. Lots of volatility, especially ending 12/24 of last year. So a year ago, the market was down right at 20%. So if I pull this up from the last October high that we had there and sort of do this measurement right here, if I can grab this red one, you can see that we were down right at almost 20%. And this market really has been in a sideways trading range for most of that time since then. So the breakout really was right up in here somewhere. So we really didn't exceed this level for quite some time. And so it's an interesting conversation to have with people because most people are feeling that the markets are doing a runaway train type of thing. So from January of last year to now, let's call it 12% up. Here's a 2-year look at the same index. So your average is right around 6% a year, maybe a little less than that, 5.5, something like that, 5.75. But you can see we haven't made a whole lot of ground since then. But we are making new highs, and this is the best of the markets out there. So let's look at another place. Let's use an index. Vanguard has an index called the World Stock Market. So this is a pretty good index. And you can see from January of 2018, so we're almost at 2 years on that mark right there, 22 months, something like that, 21 months, 23 months, that what you'll see there is we're up, and let's make it 2% for that almost 2-year window. So just understand that the markets have made new highs, but we've also made some significant downturns over that same window of time. It's not an easy thing to look at. You know, you can just close your eyes and say, hey, the market's up, and depending on whether you're measuring from right here, which was about the first day of this year, or measuring from here, which was just, you know, July of the previous year, you can see that your window changes a lot. So I'm just telling you, ignore the media. The markets are up some. So this is everybody, including the United States. Pretty good, pretty good. You know, but as far as that 2-year window or the 5-year window, now the 5-year window is significant. Right there's the 5-year window. So for 5 years, we're up 30%. So you get to divide 30 by 5 on this one. That's a much better rate of return, sometimes substantially worse, sometimes a little better. But most of the time, you know, it's not on the average rate of return on every year. It's just the way that it works. All right, so let's get off of that gibberish there. Let's look at the bond market for a minute. The bond market up and down, up and down. Recently, up. So that's a good thing. You always want investments that you buy to be up. But I hear a lot of people say, well, as I get older, I'm going to buy bonds for safety. And I'm like, you can buy the bond market. This is the bond aggregate. iShares does this ETF, which is that index. It used to be the Lehman Brothers bond aggregate, and now Barclays Bank has it, but it's the ag. And so you get a 2.76% yield if you hold it for 12 months. And, you know, I mean, from where it was back in, you know, January of 2015 to where it is today, about an even. But sometimes, last year especially, you could see that we had a pretty good little downturn in the bond market. So again, that doesn't make it safe because you buy bonds. It just means that you bought bonds. You know, for me, every time you look at an asset, you should make the decision, should I own this or not? Not what is it? Is it going up in value or is it declining? So recently, since about right in here, you can see the bond market has been going up. So that would have been a good spot somewhere right in there. And that would have been about a 7 3/4 return. Now the bond market has pretty much made its return. Is there more? And the answer is it's going to be a little tougher to make returns in the bond market going forward. A lot of money's already been made. That money's in the bond market, so just be aware. Let's look at gold. You know, our friends in the gold world love gold. I do too, when it's going up. So you can see over the last 5 years, and what we're looking at is this line that changes, that's vertical lines up and down. So that's the daily pricing over the past 5 years of the Spiders Gold Trust, which is the price of gold. You just move your decimal point one. It's $1,390.10 is what it closed at today. So you can see that the gold market declined, and now we had a market top very similar to the bond market, and now we're starting to lose a little bit of that last market high. So is gold going higher? Not a clue. My guess is while the stock market is doing well and people are less afraid, we will see the stock market start to decline a little bit, the gold market start to decline a little bit because less fear involved. You let some fear come back into the market, let China say something bad, let Iran do something with a bomb or North Korea do something, and we'll probably see the gold market move back up. But it's an emotion trade. Gold pays no dividend. Gold has no earnings. Gold is gold. It's just a shiny piece of yellow metal. In my world, you should have a little bit of it, but it shouldn't be your retirement plan. All right, so we've looked at the stock markets. We've looked at the bond markets. We'll look a little deeper. The index that best looks at China. This is not just China, but this is the emerging markets index where China is one of the components. And you can see that China, that the emerging markets peaked right here, January, once again, of 2018, and has not made that same market high again. So as we sort of slide this thing over, you can see recently, since we've started to have better news from the tariffs, that we're starting to have a little more market return from emerging markets. But still, nothing's happened for a long time. I mean, if you go back over here and look back as far back as 2014, which is over here, guess what? We're sort of in the same place. So again, owning this asset class only makes sense if you buy it somewhere in here where it's actually starting to go up, and if you take some profit somewhere right in this range right in here where it's actually going down in value. Adding to this and just owning it would have made you nothing over that window of time other than a dividend. Let's look at our friends in Europe. Europe, Australia, and the Far East is a really, really significant index. It has Great Britain, it has France, it has Germany, it has a lot of the peripheral countries in there. It has Japan, it has Canada, it has Australia. So these guys right here, EFI, this index, is a very, very significant index. This is kind of all of the developed world with the exception of the United States. So you can see, again, money's been made, but that's 5 years ago, December 2014, market top last year, and now it's starting to fight its way back up. So again, taking a profit somewhere in here, adding back in this window right in here would have been a better choice than riding this thing, say, from here to over here. So, those are the philosophies that we espouse. Don't buy something that's going down. And so that's kind of par for the course. You can see it when you see a 5-year window that owning this index for 5 years didn't give you a whole lot of return. So it would have been better to have been a little more tactical on when you bought it. Did it go up? It most certainly did, but it hasn't done a whole lot of good so far. So if you're up over 5 years, 15%, let's call it 16%, be done with it. So you divide that by 5, that kind of gives you what's happening there, 3% a year, 4% a year at the most. That's what we're looking at there. So again, just beware volatility, and then listening to the media talk, you can think that things are a whole lot better than they are. The world's economies are starting to struggle a little bit. Why? Because it's time for them to reset themselves. There's nothing wrong. There are some things wrong. Overseas, there's a lot of problems, in China and Hong Kong. There's a lot of problems in Venezuela. You see people in France protesting, but all in, the economies are still strong. So just be more attentive to the fact that the markets are going to be more volatile going forward because they're expensive. And because we have these darn computers and people can trade on any type of news whatsoever, and they do. So just take that with a grain of salt, and we've got your back here. We're not going to stay in a prolonged downturn. I can assure you of that. Anyway, we're going to close for today. If we have any questions, call us 336-448-1086. Be happy to answer any questions. You can just give me a call. Otherwise, have a great and Merry Christmas. Be safe, and we'll see you again after the new year.